Regional banks are in free fall. Fast food is feeling the recession. And somebody did, who said layoffs? Who was that? We have current events, February 6th, 2024. I am your host, Sot L, seeker of Truth L, speaker of Truth L. And we're going to jump straight into these current events. As always, check out welcome-to-the-foundation.com. Please sign up for that email list. Exclusive offers, events, invitations, knowledge, things of that nature. We're keeping it moving. IRS to boost enforcement workforce by 40% by year end 2024. Yep, I came in hot, didn't I? The Internal Revenue Service intends to raise its enforcement personnel by 40% by the end of this fiscal year, with revenue agents seeing the largest workforce increase. Revenue agents. And it's by the end of the year. No, fiscal. That's September. End of their fiscal year, September. Governments, they don't run their fiscal years end in December. Look it up. I could be crazy. What do I know? For the fiscal year 2024, the IRS plans to boost enforcement staff by a net 5,462 employees, according to a January 29th report by the IRS watchdog Treasury Inspector General for Tax Administration. This would take the total number of enforcement personnel at the tax agency to 18,960 by the end of fiscal year 2024, which is 40% higher than the staffing at the beginning of October 2023. And notice how they said October? Oh, the beginning of October. And they keep saying fiscal year. You got to pay attention to the words that are being used, y'all. Q4. Earnings are shaping up to be the best of 2023, but there's a catch. Remember they saying, you got Biden saying that, grocery stores need to stop charging. But, it's actually the corporations that made record profits. Almost halfway into earnings season, profits are clearly coming in far better than anybody expected, helping companies' bottom lines this round are easing input costs. More emphasis on cost controls and efficiencies and significantly reduced expectations. Cost controls, a lot of people got laid off, but the strong figures come after earnings expectations tumbled going into the reporting season. And there's no positive momentum looking forward. What are they saying? It's all bad in the future. It's not looking good. Despite ongoing macroeconomic concerns that have hampered demand and weighed on consumer sentiment almost halfway into earnings season, profits are clearly coming in far better than expected, helping companies' bottom lines. But, stronger than expected results for three sectors. Yeah, as good as fourth quarter results have been, there's still no positive momentum looking forward. Both first quarter and full year 2024 earnings estimates have come down since January 1st, as companies have issued cautious guidance this earnings season. So you got this going down. It's happening. Piedmont, which was this? Piedmont Lithium lays off 27% of its workforce. This is an American mining company. U.S. miner Piedmont Lithium. Yesterday, today, doesn't matter. 27% reduction in its workforce. We got that going. Fast food chains feeling the heat. How so? CNBC. McDonald's is promising its best burger. Now the chain will see that diners will buy more. There's a specific spot that I'm looking in that I want to show you. The company's same-store sales in the U.S. grew just 4.3% in the fourth quarter. It said yesterday that's an obvious lag compared with the third quarter's 8.1% U.S. same-store sales growth. That's almost half. They almost dropped half. That's really close to half that they lost in sales growth. That's a lot in just one quarter. Now, granted, I'm just going to be let me be non-biased, and I'm going to say the fourth quarter, traditionally, a lot of people are buying a lot of presents. So maybe, money isn't being thrown in these directions, fast food. But that number right there, this number right here is that's all bad. That's all bad. Let's see if they're new, their new burgers and stuff. We'll do a dance. Credit card delinquencies surged in 2023, indicating financial stress. New York Fed says, this is the Fed saying this now. We talked about this one, maybe two, maybe three times. I don't know. Credit card delinquencies surged more than 50% in 2023 as total consumer debt swelled to $17.5 trillion, man. Total debt rose by $212 billion in the quarter. That's a 1.2% increase quarterly and about 3.6% from a year ago. Not only that, we have credit card and auto loan delinquencies are highest in more than a decade. CNN Business, you got to add in the auto loans. They just want to talk about the credit cards. I'm telling you, auto loans, mortgages, people paying rent, it's going down. Americans, particularly millennials and those with lower incomes, are becoming increasingly overextended financially. Credit card and auto loan delinquencies have not only surpassed pre-panorama levels, they're the highest they've been in more than a decade. During the fourth quarter, U.S. household debt hit a fresh high of $17.5 trillion. When we just heard this is up 1.2% from the 3 months before. Debt balances increased across the board. The credit card balances rising $50 billion to hit a new nominal of $1.13 trillion. And this is adjusted for inflation, of course, while rising, debt levels shouldn't come as a surprise, especially when the holiday season typically correlates with heftier credit card balances. New York Fed researchers say they're keeping a close eye on the extent to which Americans are falling behind. Quote, credit card and auto loan transitions into delinquency are still rising above pre-panorama levels. This is Wilbert Vanderklau. I tried 3 times, y'all. This is economic researcher advisor at the New York Fed, who went on to say, quote, these signals increase financial stress, especially among younger and lower income households. And this is just going to continue. Let's talk about this. We got the regional lenders, commercial real estate exposure and spotlight after the carnage. What are we talking about? There's a sell-off in regional U.S. bank stocks triggered by the New York Community Bank Corp last week has brought their group's exposure to commercial real estate in focus for analysts and investors alike. Spoke on this last year. We was talking about this last year. It's a lot. It's a lot of money, and they're gonna have to refinance. And these corporations are used to refinancing at 0%. Now the interest rates are not at 0%. This is gonna be a massacre. I'm telling you, the industry has grappled with looming losses on commercial real estate loan books because they're not paying their. There's a crazy vacancies in commercial real estate. It's like over 1 billion square feet or like 100. I can't remember the number. It's crazy though. It's crazy. Financing difficulties amid high interest rates as the sector faced the twin challenges of financing difficulties amid high interest rates and lower office company occupancy due to widespread adoption of remote work. Investors fear weak demand for offices could trigger a wave of defaults and put pressure on banks and other lenders. Look, there's something going on with the banks. I'm not playing. Financial disaster is looming for American commercial real estate. Here's what experts see happening next. Business Insider. There's a potential financial disaster looming over America's debt-stricken commercial real estate sector, and a boiling point could come as soon as next year. Yo, when was this written? Oh, my bad, 2023. Well, they're talking about this year. Markets have been jittery over the commercial real estate since early 2023, when the collapse of Silicon Valley Bank raised concerns about a $1.5 trillion of debt in the sector that's approaching maturity. Alarms for the industry have grown louder under the specter of higher for longer interest rates. Defaults and delinquencies look to be on the rise. Meanwhile, property values are continuing to plunge, particularly for office buildings slammed by persistent work from home trends. And look, you got to have your commercial real estate value has to be, there's a debt to value, or, debt to income and debt to value ratio. When these guys are looking for financing or refinancing, they're putting a lot of their commercial real estate portfolio up for the refinancing. But, if it's losing value, if it's not worth as much as it was, you could use, you might not be able to get the money that you need. It's, four things experts see ahead for the commercial real estate. Slumping office prices. Office property prices are set for another 20% decline in 2024. Bank losses. Banks could lose around $160 billion from commercial real estate. This makes up about a quarter of the average lender's assets. Rising defaults. Around 14% of all commercial real estate properties are already in the state of negative equity. And this is from December. So this is about 3 months old, 2.5, 3 months old already. Zombie offices. Office buildings could soon be abandoned as work from home trends continue to take hold. Not looking good. Moving forward, y'all pay attention. Wall Street is worried about another regional banking crisis. You see what I'm saying? Wall Street is experiencing a case of deja vu. It's been nearly a year since the collapse of 3 U.S. regional lenders left financial institutions and regulators scrambling to prevent the spread of a banking crisis. Today, investors are worried they're back on familiar territory. But while the last crisis was about interest rate risks, this one revolves around the $20 trillion commercial real estate market. 20 trillion? Is it 1.7 trillion? The U.S. banks hold about 2.7 trillion in commercial real estate loans. The majority of that, or about 80%, according to Goldman Sachs, is held by smaller regional banks. This is why it's a problem. 80% of $2.7 trillion in loans in the commercial real estate market are held by regional banks. This whole thing with the regional banks, it's not looking good at all. Well, there was something else I had. U.S. banks see massive deposit flight, biggest since SVB's Fed ends the BTFP. So, listen, you have investors are choosing super safe money markets where 6-month bills yield about 5.17%. as the Fed sticks to the higher for longer policy. So this is hurting the regional banks. They're getting a better return in money market accounts than they are in, corporate checking accounts. And, most, like I said, most of this regional banks. It's not the big banks. Prime funds, which tend to invest in higher risk assets such as commercial paper, meanwhile, saw assets rise to $994 billion. A $7.32 billion increase. Look at this, man. Institutional funds saw a large $33 billion inflow, and retail funds saw yet another inflow, right? Look at this. This is crazy. After a small expansion the prior week, the Fed's balance sheet contracted, okay? And then for the first time since May of last year, the Fed's BTFP facility dropped after the Fed crushed the ARB and vowed to end it, or the ARB, on time in March. The reverse repo facility saw more liquidity drawn down, and U.S. equity market cap remains decoupled. Look at this. Look at this. So the red line is the U.S. reserve balances with the Federal Reserve banks. The green line is the Bloomberg United States stock market capitalization. Look at this. You see these divergence. It's this chart right here. Look at this one. This one's bad. Small bank cash flow reserves in the blue. Look at that. It's dropping. The red line, small bank cash. And the green line, large bank cash reserves. What's happening? I see look, a lot of regional banks are going to be out of here. And then you're going to have things happening like this. JP Morgan to open more than 500 new bank branches over the next 3 years. Oh, I mean, how are they going to do that? Well, there's not going to be very many regional banks. JP Morgan Chase said today it's embarking on one of its most aggressive bank branch expansions in recent years, with plans to add more than 500 new U.S. locations by 2027. That's 3 years. This is, of course, to broaden its footprint in areas where it is underrepresented. The multi-billion-dollar investment will see it open new branches because they see the writing on the wall. They see what's going on with this. They see what's going on. Look, if I'm gonna show you this chart again, right? Look, if you're looking at the cash of banks are running out of money. Flight is happening, and they're going to money market accounts. And I do believe JP Morgan can do money market accounts, Fidelity, so on and so forth. Like the bigger banks can do that stuff because you got to deal with the SEC. Small bank cash reserves is out of here. Look at that. And then the green, of course, is large banks cash reserves. They doing the dance, of course. So JP Morgan's gonna be out here. It's gonna be out here. Let's jump out of here. Honda recalls, 750,000 U.S. vehicles over airbag defect. Listen, if you bought a car during the panorama, during the times where you couldn't go outside, you should be very careful with that car. You bought an SUV, don't care. Well, it's not a car, it's an SUV. Truck, utility, doesn't matter. If you bought one of those things during the sit down time, the timeout, I would be very, very careful. There's a lot of recalls going on with these dances. And then last but not least, of course, cyber attack on Chicago's Children's Hospital has shut down its systems for a week. Watch out for these cyber attacks. Please. We're working on cybersecurity in the Foundation magazine. We're definitely in volume 3. We're going to do personal private security. We're going to get into that. And somebody emailed me and they were like, how come your browsers don't have any ads? When you're looking at articles and stuff, I don't see any ads on the side. Well, that's part of my privacy. I don't allow that. I don't allow ads to call home and then load stuff on my pages, which, protects a lot of my, information and, protects from DNS leaks. So, these cyber attacks, there's a lot of things that you can do. We're getting into this. We're working on it. We're definitely working on it. Just pay attention, stay tuned. Also, sign up for the email list. Please sign up for the email list. Just do your dance. It's cool. You don't have to. Just, do your dance. We have trustee training. Yes, it did increase. Yeah, it increased. And, it's going to keep increasing. We're just, if you're on it, you're on it. If you're not, you're not. And if you know what this is, you know what it is. I mean, I've been doing this for almost 10 years now. And if you know what it is, you know what it is. If you don't, you don't. Good luck with all this other stuff if you don't. How to start a business, I suggest you do that. Layoffs are everywhere. It's only $20. That's it. $20. Forever access. It'll always be yours. It's not going to be taken away. This is what I'm saying. Cybersecurity. Foundation magazine. We have digital. We have a print edition. You can get either or. You can get both. We got some people who got both. We appreciate that. Shout out to you if you got both. And look. Private invitation to the private side of Welcome to the Foundation. Private portal, get your own membership area. There's a lot of stuff back there. Free course, a lot of courses, a lot of information, access to documents. If you have heard it or seen it here at the Foundation, it's that and more. That and more is on the private side. So I definitely want to say appreciate y'all checking out the show. Or I'm sorry, current events. The show is tomorrow. Just prepare. We got your back as far as keeping you informed. And y'all have a great week or a great day, weekend. Enjoy yourself. Take care of yourself. Make sure you say 10 things that you're thankful for before you go to sleep tonight and every night. It is very important. And I'll catch y'all tomorrow on current events and the Foundation episode. Peace.